The Dow Jones Industrial Average lost 200 points today, its biggest drop in 3 years. But wait, just last week, didn't the market almost have its best close ever? Here to sort out what's going on is Robert Stein, portfolio manager at Chicago's Astor Asset Management. Rob, welcome back to Chicago tonight.
Thank you, Phil.
In addition to your role at your company, I mean, you are an economist. So please, in plain terms, what happened today?
Well, the market's getting a little scared about inflation. There's been a report out today, and there was another report yesterday, the CPI, the Consumer Price Index, and it showed that inflation might be percolating up a little bit more than we had expected.
And why does that make the market nervous?
Well, as inflation goes up, it slows the economy down a little bit because the Fed, in order to fight inflation, continues to raise interest rates. And as you know, the Fed has raised interest rates 16 times now. And a couple of years ago, mortgage rates and other things that are tied to benchmark interest rates were lower, and we were able to afford more financing.
So the concern is that if inflation, if there is a concern about inflation, that the Fed rates go up again, and that is spooking the market.
They will continue to fight it. In fact, about a month or so ago, or 2 months ago, when the transition from Greenspan, the former chairman, to Bernanke, the current chairman, they were thinking that the Fed would stop raising rates right about now. And after today's report, it looks like there's higher interest rates ahead.
Okay, but last week, things seem to be going so well. You're saying that one report can really turn things around like that?
No, it's not so much one report. I mean, although the market was making a high for the last 4 or 5 years, and in some indices an all-time high, we haven't really gone very much in 3, 4, 5 years. So we didn't have far to go to make that new high. And in fact, we haven't really fallen that much either. Okay, a couple 100 points today, 100 points or so yesterday, but we're still up in the air, up for the year in the S&P, and the market over the last year or two, when oil prices started to really escalate, isn't doing so bad.
So your assessment of how the economy is doing overall?
I think the economy is doing very well, and consider the headwinds incredibly well. You have oil prices at about $70 a barrel. You have interest rates that have gone from 1% to over 5%. And you have an economy that grew at well over 4% for the first quarter. And Phil, most important, the unemployment rate is now well below 5%. Those are signs of a pretty strong economy.
So what happened today on Wall Street doesn't particularly freak you out?
Well, Wall Street, or the stock market, if you will, looks about 6 or 9 months ahead. And what they're saying is, gee, today's report is giving me some concern. And keep in mind that commodity prices really had their bigger move in the month of April and in March, and those didn't show up in today's report. So what we're seeing is a potentially higher inflation outlook in the months ahead, which will force the Fed to continue to raise rates, which might slow the economy down 6, 9 months down the road. And I actually agree that that will probably happen.
Okay, now last week when the market was doing so well, some people thought, you know what, this is a momentary spike, and there's probably a correction that that we can anticipate. Is today perhaps that correction that some people were talking about last week?
I think today is the beginning of that correction. I do believe that there is some more room in this correction while the economy takes a breather. So I wouldn't say it was a 1 or 2 day phenomena. I think we're going to have several months of a challenging market environment. But I do not think that we're going to be in an environment like we had in 2000, 2001, where we were in a full-blown recession. That, I believe, is well over a year away.
Okay, so what do you say to people who have mutual funds or who look at their 401k statement and think, well, you know, the last one we got, not so bad, but what's going to happen next?
Right, well, we're only talking about a couple of percentage points change for the last few days. So, you know, the old adage of hold the course, I think, applies here. Maybe take your portfolio and look and see how you're diversified, because one of the mistakes people made in the beginning of this decade was to be overinvested in one particular sector, notably technology and the NASDAQ. If you have a diversified portfolio of large cap, small cap, mid cap, and bonds, I think you'll be able to weather out the coming, I'm going to call it contraction, and be positioned well for when the economy has its upswing again, which it inevitably will.
Okay, so during the course of this contraction, what's the next thing people should look for as an indicator of just how much contraction is going to take place?
Sure, I think watching the employment numbers that are come out, and the government produces the employment numbers the first Friday of every month, and we've been adding 150,000 jobs about each month. And I think if you start to see the unemployment rate go back up, or start to hire fewer workers each month, that would tell me that the economy and the market might be in for a little more trouble.
All right, Rob Stein, thanks again for being here.
Thank you.
Appreciate your insights and explanations.